This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Let's go through then and start our journey into IFRS 5 in earnest by looking at your non-current assets held for sale. Hopefully from the introductory video you've understood the basic principles surrounding the standard. It's all about disclosure. It's all about being able to help the users of the accounts give a little bit more predictability about the future. We're now going to go through and start to look at some of the rules and then crunch the numbers. So I think if you have a look at the notes that you've got up there, the first bullet points go through and talk about what a non-current asset held for sale is. I think we've effectively covered that already, haven't we? Whereby, we are using this asset in the business, but we've decided to sell it. So therefore, we're no longer using it. We're not going to generate the profits from using it over more than a year. So it should no longer be classified as non-current. So it should therefore be current. That one. Excellent. There. Got it? Yeah, fine. I'm not too worried. You can include it. I don't think it's going to be seen at CIMA F1 level. It's a bit too complicated because we don't look at consolidations in any detail just yet. But what you've got there as well, if you decide to dispose of a group of assets, it could be dispose of a part of a business. So you get rid of the assets and the liabilities. So it's not just PPE. You're going to have a disposal group. But not too worried. Maybe disposing of a subsidiary, another part of the business. The focus here at this level is selling property, plant and equipment for a non-current asset held for sale. In order to be able to go through and do the classification, so we said before, didn't we, it's about the value, but also we need to think about when it can be done so that the accounts can't be manipulated and that asset be moved backwards and forwards between categories, and therefore stopping depreciation being charged and improving the overall profitability. So in order to classify it as held for sale, we must be able to sell it immediately in the way that the asset is held, so in its present condition, and the sale must be highly probable, i.e. it's more likely than not to go through. So in order for that to go through and happen, we've got some key criteria. So again, I think these might be part of a non-computational objective test question. So you might have to select 2 out of however many which are criteria, or there might be one of them that is not one of the criteria of IFRS 5. So what have we got? And the key thing to think is that these criteria are designed to ensure that it is actually going to be sold. Otherwise, we will not categorize it as a non-current asset held for sale. So we must be committed. So it's not like, oh, we're thinking about selling it. We're not too sure. We're going to, maybe not. Oh, boom, we're committed to sell. We're getting rid of it. It's going. Okay. That's the first one. It must be marketed at a price that is reasonable. So we're looking to sell it at something around its fair value, so what it is worth. We're not trying to sell it at a ridiculously high price, because therefore, if that's the case, we're not going to get the value of that asset. We're going to get its fair value, aren't we? It should be taking place within 12 months, which I suppose goes back to the difference between non-current and current assets. And there should be no changes, or unlikely that there will be changes to the plan. If there are, then you can't categorize it as a non-current asset held for sale, because you could change your mind effectively, couldn't you? So just note those, learn them. You might see them in the odd question here or there, but I think the main focus is going to be on the computational aspects. So that's the when, if you like. What about the value? What amount are we going to hold it at within your financial statements as a non-current asset held for sale? Well, the information that you require is here. So your non-current asset held for sale is valued at the lower, that's important, of the carrying value and fair value less cost to sell. So this figure that you have here is at the lower of either is it your fair value less cost to sell or your carrying value. And effectively what it is doing, it is using the accounting principle of prudence, because we're saying there, well, look, if we are going to sell it, i.e. at its fair value less cost to sell, and that is below its carrying value, then effectively we know straight away that we're going to be selling it at a reduced value and therefore a loss. So therefore we should recognize that loss immediately. However, if we anticipate selling it at a value that is higher than its carrying value, then let's just transfer it down at its carrying value and we'll recognize that anticipated profit when it is actually sold. Makes sense, doesn't it? So when you transfer it at the lower, what you should then find is that if it does go in at your fair value less cost to sell, then any impairment, the reduction in value, just goes through profit or loss. So within that year, you will have an asset that's non-current asset held for sale. You'll have the depreciation up to the date to which it is transferred. And then we will also have an impairment showing that reduction in value prior to its ultimate disposal. Again, I think I've mentioned it already, but once you've got it as a non-current asset held for sale, it's no longer depreciated. So again, you can add that there. There is no depreciation, but there will be depreciation up to the date of reclassification. And then when you subsequently sell it, you just get a profit or loss on disposal. A bog standard profit or loss on disposal being your proceeds less the value of the non-current asset held for sale that is held within your accounts. What we've gone through and done is we've looked at everything there or spoken about it through the cost model. One, again, minor point to note is that if you have the revaluation model, so remember, keep your eye out on the question. Normally, that tends to be for the land and buildings category, doesn't it? If it is land and buildings, if it is held under the revaluation model, what you do, you revalue it to fair value prior to any classification as held for sale. So you are holding it there, it's carrying value within the financial statements. You then revalue it straight away to fair value, treat any gains as normal under IFRS 16, with those gains going to other comprehensive income, and then we then transfer it at the lower of the carrying value and the fair value less cost to sell. There we go. So just keep an eye on it. What I would do first of all is I'd make sure that you're happy with the concept applied to the cost model, for which we'll see an example shortly, and then you can have a play around with your study text or your question banks and your chosen tuition provider to have a look at it for when it is the revaluation model.